Welcome to Lesson 9, Part B. We are going to talk about the Forex risk. Remark that resorting to underfunding is also beneficial in terms of foreign exchange risk mitigation. ECN markets offering CFDs are not subject to foreign exchange risk because the accounts can be denominated in euro, Swiss francs, or British pounds, regardless of the fact that the underlying financial issues are US dollar denominated. But if you want to operate the trading system combination on the Globex and you are not American, you have to provide funds in US dollar, whereas your domestic currency is euro, Swiss franc, or British pound. At the end of year, when you convert your profits into your domestic currency, the shift in the exchange rate in a 1 year time might completely undermine your profitability. Let us assume that we are in this case. Our domestic currency is euro, and we provide funds to a US dollar denominated account in order to operate on the Globex. If we resort to underfunding, the amount of our US dollar denominated funds will be just the 50% of the notional value of our investment. That will mitigate the Forex exchange risk by a 50% factor. That's remarkable, but let us make an accurate assessment of this risk before thinking of mitigation strategies. Let's then analyze the combined effect of the system returns and the Forex gains and losses. Let's do that in general without focusing on the MASASP system combination. Let's take the Standard & Poor's index instead. According to the International Capital Asset Pricing Model, all stock indexes are slightly negatively correlated to their currency. Though it is not sufficient to compute the correlation between the stock index and the currency in order to estimate the combined effect. In fact, there is no easy closed form solution for that. So, the combined return is estimated according to this formula, where the system return and the Forex gains and losses are respectively at the numerator and at the denominator. As an example, if you have a system return of 10% and the euro appreciates over the US dollar by a 10% factor, you wind up having no profit at all, thus a combined return of 0. This intuitive observation fully complies with our formula. MASASP simulates the system return distribution, the topmost chart, the Forex gains and losses distribution, the middle one, and the combined return distribution at the bottom. The latter takes account of the former two distributions according to the formula shown in the previous slide. You see that the euro versus dollar exchange rate didn't change significantly in the observation period. In fact, the mean value of the top distribution is rather aligned with the mean value of the combined effect distribution. Remember that these are annual estimates. Well, let's switch our focus to the standard deviation, to the volatility. Due to the slight negative correlation mentioned in the previous slide, the US stock index volatility is higher than that estimated, accounting for the Forex exchange rate effect. Well, these are positive findings for our European investor. In this chart, we can have a look at the Forex exchange gain and losses on a semi-annual time frame in the last 18 years. It is apparent that the shifts in the exchange rate offset each other in the long range. In fact, at the end of this 18-year observation period, the appreciation of the domestic currency over the US dollar is negligible if compared to the US stock index appreciation. It would be even more negligible if we took into account a system combination such as the MASASP SPG4, which overperforms the US stock index. We can also expand our observation period going back to the 20th century. Let's take account of year 1999, for instance. The exchange rate quoted 1.15 in January 1999, and it quotes 1.11 at the end of year 2019. It is just a 3.5% shift in a 20-year observation period. Really negligible. The situation is completely different if we take a Swiss franc as the investor domestic currency. The mean return, accounting for the Forex gains and losses, is smaller than the US stock index return in US dollar. If we take a look at the Swiss franc performance over the last 18 years, we understand why. It is apparent that the Swiss franc has undergone a discrete appreciation, and that, of course, would have undermined the profitability of a US dollar denominated investment for a Swiss investor. The MASASP Forex component provides detailed scorecards for all the major currencies in order to assess whether consistent Forex exchange risks exist and whether it is worth to resort to underfunding in order to mitigate them. Well, that's all for the time being. Thanks for watching, and see you at lesson 10.